The title, Step Change. So, I'll be discussing a whole number of things, but particularly the Bank of England meeting and the cut, but not just the cut, but the breakdown of the vote, which was very important. But if you've listened before, you'll know I like to start with a quote. And this week's is, high inflation in Britain has not been vanquished, and it is more likely to overshoot than undershoot Bank of England forecasts over the medium term. BOE interest rate setter Catherine Mann said on Wednesday, that was November the 13th, 2024. Mann cast the lone vote against cutting borrowing costs at a meeting of the BOE's Monetary Policy Committee last week, which decided by an 8-1 margin to lower the bank rate to 4.75 from 5%. And she also opposed an initial rate cut in August. And that was from Reuters, who was reporting on the lone hawk that was Catherine Mann at the last meaningful meeting of the Bank of England that was accompanied by a quarterly updated forecast and monetary policy report. And that was the most meaningful meeting before the meeting last week, which saw the bank cut from 4.75 to 4.5. But not just that, it saw Catherine Mann vote to cut the rate by 0.5%. So a complete volte-face of a 0.5% difference within actually about 7 weeks, because the non-report meetings are in between the report meetings. There's a meeting every 7 to 8 weeks of the Bank of England Monetary Policy Committee, or 6 to 7 weeks, I should say. Anyway, before I get started in earnest, our next property business workshop is Tuesday, the 1st of April, where the topic is due diligence. An entire day on due diligence, which is back after popular demand, and expanded on our last DD workshop from 2024, where we also covered 2 other major topics in the same day. But this is fresh content and ideas, and the tickets are live and selling at bit.ly/PBW and a number 6. Those super early bird tickets have got a genuine 25+% discount on face value, and when they're gone, they're gone. They are already selling well. I'm also collaborating with a couple of others to deliver a course on finding deals. Due to time constraints, we only run a maximum of 2 of these per year, and it may indeed be the only one for 2025. Alongside Daniel Kennedy and Nick Bond, I'll be there. This is Birmingham based, talking through, no holds barred, the methods we use on a daily basis to find a healthy stream of property deals, whether you're looking to buy them for yourself, become a property trader, or earn an extra income stream through sourcing for others. We run these because, as per any of the training I get involved in, we're actually doing this with 90% plus of our time, and then talking about it with 10% of our time. That's the right ratio in my view to get real world and up-to-date information. It's great value, very intensive over the 3 days, and as always packed with content. The first 9 tickets are now sold, and only 11 more are available to ensure we get to the right level of depth and detail with everyone attending. This is going to sell out, folks. 20 is our limit. There's more details if you're interested at propertymatchmaker.uk/sourcing-solved. Anyway, welcome to the supplement proper, as we process one of those weeks that really makes you question some fairly deeply held beliefs. Auctions continue to be mixed, with a fair amount of what looks like overpriced stock and some failures, but still plenty seem to sell too high, especially in our new world of 5% additional stamp duty. I swear half the buyers haven't even clocked it yet, but really that should be no surprise. The air must be blue around completion statement day. And then this week's deep dive sees me go into the Bank of England Monetary Policy Committee meeting from last week, their 0.25% cut, and how the vote broke down, and what that all means for predictions going forward when it comes to interest rates, swap rates and gilt rates. And then in the real time slot, Chris and the property market stats are right back to full speed. We get to ask that question we love to know the answer to: what is currently happening in the UK property market? Now, we've got some month-on-year comparisons to consider now that January's data is complete. From Chris, listings in January 25 were up 12.9% on January 24. Gross sales in January 25 were up 19.7% on January 24. Net sales in January 25 were up 29% on January 24. And UK house prices on sales agreed were 3.6% up on January 24. For the week, listings were at 34,900, seeing the year 12% higher than the 2017 to 19 average thus far. 12.1% reductions compared to the long-term average of 10.6. So, more stock, more reductions, both relatively and absolutely, in an effort to get things sold. Gross sales were right up 27,500, 37% higher than 2017 to 19 levels. Fall-throughs were down to 22.5%, which is lower than the long-term average, so the market looks pretty stable. And with all that in mind, net sales look equally good at 32% higher than the 2017 to 19 average year-to-date thus far. January's pound per square foot data was in, and £342 a foot compares favourably with £330 a foot in January 24. If it all feels a little rudderless at the moment, that's maybe because it is, but the market will need to make up its mind on the direction of travel when the next couple of months' figures drop in. Now, Chris Watkin deserves a mention because he's more prolific than just this epic tome he releases weekly on the UK property market. He comes up with some great stats on a regular basis. Drop him a like, subscribe and all the rest of it, and some kind words for his content creation. If you're in the industry and you want a ghostwriter, that's his core business, give him a shout. His article gets published every week on the Property Industry Eye website and the video on his YouTube channel. So we segue from the real-time UK property market to the macro, seamlessly as always. Halifax took their turn at a house price index. Then my favourite PMIs, telling us more about the real-time economy and the private sector sentiment and viewpoints, followed by the Bank of England BBA rate report, crossing a downside threshold this month. And then you know the rear is brought up by the gilts and swaps markets, of course. So the Halifax house price index then. They slid out a positive January at 0.7% increase seasonally adjusted for house prices. This caused Halifax to fire up the band as they now passed their previous record for the price of a UK house in the UK. No mention of inflation though, of course. Their annual growth slipped to 3% though, as they did start 2024 with a bang in spite of their poor bearish predictions for that year. The Halifax head of mortgages recognises what you'd expect her to. Market resilience and the stamp duty reintroduction deadline probably driving some transactions. No incentives like a tax break ending, let's face it. She suggests mortgage rates will hover between 4% and 5% in 2025, which wouldn't see gilts moving far from where they are today. There's a fair few that believe we can again go below 4% as we did for a chunk of 2024 after Thursday's Bank of England vote. She also mentions affordability as her contractual obligation, you would think, but this time seeks to focus on lack of supply being the true driver of this market. Northern Ireland still wins the battle of the devolved nations, with 5.9% being the Halifax year-on-year figure, well ahead of Wales in second at 3.6%. It's a pretty quiet reporting month for Halifax, as they don't really say much more than that. The PMIs are always richer in content, and I'll start with the services as by far the biggest contributor to the overall economy. The flash number at the end of Jan was 51.2, which was an improving number, a post-budget high actually, but this was a false flag as we settled down to 50.8 as more data came in. December's services PMI was 50.9, so it was instead another slip downwards. That fired up the misery machine and the press jumped at it, as so often, of course, the reality is this is an economy in the now that is clinging on to growth by the fingernails. So where did the services PMI pitch the headlines? New work declines for the first time since October 2023, renewed downturn in order books, marginal output growth in January, fastest reduction in employment for 4 years. 4 years, and what a 4 years that is to be comparing to. Ouch. The heart to be taken from this report is that the changes upwards or downwards are very much at the margin, but it does feel a lot like the second half of 2023, where of course we had a technical recession, but the real story was that the economy was going sideways at a rate of knots. There's a difference, however. In 2023 you could blame inflation being well above target. That's not where we are today. Above target, sure, but within the acceptable range. In the UK we use 1.5% to 2.5%. In the US they use 1% to 3%, which is a bit wiser, to be honest with you. So what did their economics director have to say at S&P Global? Stagflation conditions, bit strong with where inflation is today, but there's no rule for how high or not that inflation has to be. Stagflation is generally poorly defined. And that treacle feeling does justify what the reports are saying for sure. A challenging business environment. Input cost inflation up 5 months in a row to its highest since April 2024. Rising salary payments sharply is the phrase that was used, and suppliers were highlighted as passing on the forthcoming increase in employers' national insurance contributions. and everyone who is worth their salt knows that's just inevitable. Tim Moore, the economics director, points out that in the near-term economic UK outlook remains tilted to the downside. Here's some more reality though. Risk aversion, subsequent cutbacks, making it a self-fulfilling prophecy. Tech services spending as winning a small area. Tech services spending is resilient, as winning a small area in the global AI land grab remains very attractive for the larger corporations. Expectations for the year also dropped, with optimism the lowest since December 2022, when we were still reeling from the lettuce. That's right. The report was published before the bank vote, and whilst the result was almost a known, the way it came together was not. Thus, the elevated interest rates compared to where we were a month ago look vastly different. Recruitment breaks, shrinking workloads, rising payroll being the two dominant factors were put on, and completely unsurprisingly, leisure and hospitality indicated the sharpest rate of decline. So manufacturing was a tiny bit the other way. The flash was 48.2 and the print ended at 48.3. This is still less positive because it's the wrong side of 50, just to be clear. The roundup in the report highlights small companies feeling it hardest. A good example of this in retail was the revelation that Next would have to find an extra £70 million to pay the extra national insurance tax this year, but it had made £1 billion profit. So that was 7% of last year's profit to them, whereas the percentages may well look very different in smaller companies. A pickup is needed, and again, it isn't expected in short order. Construction is now joining the doldrums in an immediate and sharp way. We don't get a construction flash number, and there was a pretty big surprise to the downside, as the expectation was another print at the 53 sort of level, as we've been seeing over recent quarters. Instead, we got a shock as the monthly print was 48.1. It's been nearly a year since a print under 50 in the construction PMIs, February 2024, and all types of construction saw an output reduction, civils, commercial and resi. A new downturn in order books and cost inflation at a 21-month high. The same story across sectors, it seems. Worse than this, the biggest loser was resi, the fastest fall for 12 months, blaming subdued market conditions. The key word is caution, which of course animal spirits and confidence driven. Delayed decision making means the lowest expectation for business activity in 15 months. And we had another report of highest purchase price inflation since April 2023, due to rising energy, fuel and wage costs. As an aside, the price cap for April is accelerating at an uneasy rate. The 1% prediction is now up to more like 5.5% or so for April's cap, as recent wholesale prices have been rocketing week on week. Again, it's just not congruent with our 2% inflation target. So we're back to the world where services just about allow the UK economy not to slip into recession. And goodness knows what happens if they slip below the watershed. It's an ugly set of circumstances. January's news was broadly horrible though, and perhaps Feb's PMIs will be more positive than these, as Rachel Reeves' turnabout and tacit torpedoing of net zero will have an impact. I do get the feeling, as another aside as time goes on, that when you look at the stark choice that either Labour are ignorant of what policy has done and is doing to the private rental sector since 2015, or they know and they don't care, or are in active support of this, hang the consequences. And the latter is becoming my more preferred view. We had the news, there was a surprise, that 2028 for new tenancies at EPCC is back on, with 2030 being the deadline for all existing tenancies, and the price cap being raised to £15,000. We've stayed woefully underinformed on this initiative for over half a decade now, and I still remain unconvinced. But after driving a truck through net zero last week with the Heathrow announcement, or re-announcement if you like, it's all back on when it suits the larger agenda, is how I would describe it. This is one more reason for landlords to get out or to not get in, which has been a bigger problem. And my favourite factual argument about price elasticity of demand, and what gets passed on to the tenant, which is 60 to 80% of all cost increases, evidenced by the broader academic literature in this area, once again needs to be wheeled out. Miliband talks like someone who only understands property south of the Watford Gap, but not even as far out as the extremes in Kent, for example. I simply am left thanking the Labour Party for guaranteeing my pipeline of supply in 2028 to 2030 if they're insistent on pressing on with this, alongside a potential new commitment to renewing energy certificates every 5 years rather than 10. I'd score your C's now and batten down the hatches so you can catch the new stock after the RRB fuss dies down. As with the Renters' Rights Bill, there'll be a healthy slice of landlords that don't know this is coming. The government AI investment will, however, easily allow issuing of penalty notices for EPCs in let property. Or you would think so anyway. Match the name on the council tax register with the name on the land reg. If it doesn't match, match the EPC against the register. If it doesn't stack up, send it to a human to work out whether to press a button to issue a penalty notice. I'm not a coder, but from some of the things I've seen from AI already, that really doesn't sound that hard. Doesn't mean it will happen, of course. That leads me to the BBA mortgage rate. Not related to the bank meeting this week, this is the reversion rate that's being paid on average by people who are outside of a fixed term mortgage. That number absolutely inched down under 7.5% for the first time since June 2023, printing 7.49. The series high of 8.07 in July 2024 has passed, and the average of 5.75 between 1995 and 2025 is over-influenced by the zero interest rate policy period, of course. So that's January's number, and the feel is that February's will be lower again. Sliced into the DMP data, the decision maker panel data that's collected by the Bank of England, the output prices reported in here were up 3.8%, which is unchanged from last month, but expectations are 3.9% now, and CPI inflation expectations have moved up from 2.8 to 3% for 2025, as everyone catches on to Rachel's budget new world, and that having to be sorted before any of these mega projects come along to save the day. Wage growth expectations are 3.9 for the year, and the breakdown of how to cope with the budget question shows 62% accepting lower profit margins, 56% putting their prices up, 53% employing fewer people, and 38% paying lower wages than they otherwise would have done. So there's who pays for it. The firms, first of all, but only just ahead of all of the customers of the firms. Only just ahead of the people who don't get jobs on the back of all this, which is quite far ahead of those who get lower pay rises than they otherwise would have done. Thank goodness tax wasn't put up on working people, eh? Anyway, enough. Let us not take the shine off a very acceptable week for the gilt and swap yields. The 5-year gilt opened at 4.24 and decayed until the bank MPC meeting, as the writing was on the wall for a 0.25% cut. Thursday's close was 4.18 as the cut had largely been priced in, although my expectation after the way the vote broke down was a larger drop in those yields, to be honest. Friday changed very little, and the weekly close at 4.176% yield for the 5-year gilt was pretty orderly for an MPC meeting week. We accept all down weeks on the yields with open arms. The swap closed Thursday at a pleasing 3.846, which is only 13 bips ahead of where it was 1 year ago, as we came off a relative low in the yields in January 2024. This stability is most welcomed, and on my metrics, 5.85% for limited company, no fee, 5-year fixed, sees investment grade yield at 8.36 on a vanilla buy-to-let, gross. That allows for a 30% cost of delivery before financing costs. So these gilt movements can be explained, or not, as we go into the Bank of England report, which needs significant detail to understand whether this week really changed anything on the predictions front for interest rates for the quarter, year and 5-year period. And we're interested in all of those for multiple reasons, of course. So, quick revision. 8 Bank of England Monetary Policy Committee meetings per year, where base rate is discussed and voted upon. Emergency meetings on top of that if they're ever needed, and of course there is provision for that. Only 4 of these meetings are accompanied by a full Monetary Policy Committee report with refreshed data. Central bankers don't like to hurry, remember, but the area of stability is the most important part of their job. A Donald Trump-style volatility approach is not conducive to big investments, because big investors don't like volatility, mostly, unless they make their money from volatility, of course. So this was one of the quarterly meetings with the full report, and most importantly, it updates forecasts. The one you're likely to have heard about is the revised growth forecast downwards. As I said in the teaser for this week, the only surprise for me was it took this long for the world to catch on, although the past few years have seen the big organisations take even longer to catch on. It takes time and effort to get into the meat of reports like this, and the media prefers to do what it's told to do in press releases and sound bites. This report instead contains, in my view, evidence that the budgetary changes in anger, because of course they were already known about in November's MPC report, truly representing a near-term shock to the economy. Let's just zoom out a moment. If you believe you're doing the right thing, this is actually quite clever. Spend the first 12 to 18 months doing everything unpopular, then turn your hand to winning the next election and pressing the incumbency advantage home. And there is an advantage unless you've had a genuine crisis. Global financial crisis, pandemic, exit from the ERM, the winter of discontent. That basically summarises the reasons for changes of government over the past 5 decades. But the measure of this as far as a Bank of England near-term forecast goes is significant. So come November 2024, bearing in mind we were asking then about a forecast a few months ahead, the bank believed the annualised rate of growth in GDP in Q1 2025 would be 1.4%. Today they believe it will be 0.4%. Bearing in mind that in Q2 2024 the economy grew 0.5%, this represents net growth in GDP since Labour were elected of minus 0.1%. That's a hell of a revision. What we don't get is a commensurate revision upwards in the medium term. Instead, 0.1% lower in 2026 and 0.2% higher in 2027 compared to the November forecasts. So there's an economic loss there overall of 0.7% of GDP. So what? Well, that's 19 billion of economic output. 38% or 40 if you prefer round figures generally comes back in government revenue one way or another. That's 7.22 billion of money that now needs to be found, or dare I say is added to the black hole. But it's 1% in 2025 with jam tomorrow. So it's actually 10.26 billion in 2025. So I've been saying for some weeks that the OBR revised forecast, from which Reeves must balance her fiscal rules, would be revised downwards come March. This revision from 1.4 to 0.4 is so significant it could well leave Rachel needing to find £10 billion worth of cuts from the future in the spring statement, unless she's going to put taxes up. Now let me give a bit of a steer on this. If these were cuts rather than anything else, it could send a positive message to the international markets. It might even pay for itself. And what I mean by that is it might bring the yields down, and it would mean less money out the door servicing our debt. If Rachel Reeves and the Labour Party believe they will outperform on growth, those cuts would never even need to happen if they were slated for 2029 and beyond. This is the skill the game of fiscal rules take from the new future that appears every forecast period, because it might well never need to happen. It's all a bit silly really, but it is the worst system apart from all the others at this time, a bit like capitalism or democracy. All the other revisions were miserable too in the bank report. Inflation 2.8 this quarter rather than the predicted 2.4, 3% for 2026 Q1 and 2.3% for 2027 Q1, which looks a bit hopeful to be honest. All revised upwards apart from the critical number. Do not understate the importance of this. The inflation prediction in 3 years' time is 1.9% in Q1 2028. This is based on the market path of interest rates, which before this meeting was only down to about 4% within 3 years. So there's a bit of a circular reference here, or an infinite loop if you like, because the result of this meeting then influences the market path of rates, although often not significantly. But all other economic news then continues to influence the market path until the next meeting with the revised forecasts, which will be in May. So, as long as this inflation prediction in 3 years' time is between 1.5 and 2.5, then the bank is, according to their remit set, doing its job adequately. This being below 2% suggests there is room for perhaps one more cut than the market expects, or did expect before this meeting took place. Confusing, isn't it? However, the bank rate, which the bank forecasts, yes, really, was revised sharply upwards in this forecast as well. Their expectation was 4.6 for Q1, which makes sense because until February the 6th it was 4.75. For the rest of the quarter it's 4.5. Or, put it another way, they don't expect another cut at the meeting in 6 weeks' time. Or even if they do, it's nearly the end of the quarter anyway. They now forecast 4.2% by 2026 Q1, which is in line with my forecast for 2025 to end the year at 4.25% base. They forecast 4.1 by 2027 Q1. So what they're saying there is the cut from 4.25 to 4 wouldn't come until Q1 of 2027. And then terminal base rates still at 4% in 2028 Q1. So that's the new bank expectation for the rate movements, even slower than last time they modelled it. This is interesting and also not congruent with their most recent survey data from their market participants survey, who currently believe that on average, R star, or the equilibrium base rate, that's the rate at which the economy does not expand or contract based on the cost of short-term money, is 3.5%. So 4% would still be restrictive policy. So rounding up the ratcheted bearishness in the bank forecast, they also expect unemployment up at 4.5 this quarter and to hold there for a year or so. My expectations are worse, actually, nearer to 5% by Q1 2026. They then expect 4.8% in 2027 and 4.8% to hold there. I would expect that to have started to right itself by then, but this will depend massively on the minimum wage crank for 2026, since the government of whatever colour seems to be largely committed to ramping this up quickly and as aggressively as possible, without regard to youth unemployment results and similar. So overall, this bears out what I've been suggesting about the importance of March's statement. Reeve's misery is nowhere near over, and it will be hard to keep up levels of positivity for the next couple of months until her big test. But she needs to. Will the OBR follow the Bank of England? They will have to be in the same ballpark, although they're always independent forecasts. I'd be surprised if they don't talk. Okay, I wanted to get into the meat of the size of the change, particularly the massive shift in growth expectations. It's hit the headlines somewhat, but the focus has been on the growth rate for 2025, which is now expected to be 0.75% by the bank, rather than the quantum of the shift downwards from 1.4 to 0.4 within 3 months, when the forecast was only for a few months in advance in the first place. A truly huge adjustment which only comes on the back of an economic shock. Simple as that. There's one more technical explanation needed to give as I give the rest of this supplement the proper context. For this, indulge me, as I treat you to the voting history of Catherine L. Mann, external member of the committee, who I've previously described as the hawkiest hawk, and that was outlined in the quote for this week. Remember, a hawk is someone who wants to keep rates up when others think they should come down. Or not even when others think they should come down, they just want to keep rates up. So, as with all the externals, Dr. Mann is highly decorated. Harvard, MIT, chief economist at the OECD, worked at the Federal Reserve. Now, generally, Dr. Mann votes like an American central banker. She's not scared of chunky moves upwards in the rates when needed. When we were inching rates up 0.25% or 0.5% at a time, our only 0.75% move was when the good old Lechuga allowed that miserable budget to be released. Mann was voting for 0.5% and 0.75% rises quite often. She thought we should hit 5.5%, and actually I agreed with her. She voted 5 times in a row to go to 5.5. She also voted to hold when we cut in August 2024, and this has been her first vote for a cut since she first joined the committee in September 2021. Now, in fairness, that might not be quite as hawkish as it sounds. There's no doubt that at that point in the cycle that rates needed to go up. There was no reasoned argument against it. However, this meeting she proved she isn't scared of chunky moves downward either. She joined her near opposite, Dr. Dhingra, in voting for a 0.5% cut in the base rate. Now, Dr. Dhingra believes that the constraint on growth that's been put on the economy by having rates above the equilibrium needs fixing, and she's believed that for a while. In contrast to Mann, Dhingra only voted for 5.25% 3 meetings in a row, and she never voted to 5.5. She's voted cut for the last 9 meetings in a row, and this time voted for a 0.5% cut. Now, these two seem like unlikely bedfellows, but bedfellows they were, the only two to vote for a 0.5% cut in the rates. I had some interesting exchanges on Thursday afternoon for those who knew this was a more significant meeting than many that have come before it, hoping for a bit of a tumble in the gilt and swap yields and the base rate following the conversion of Mann, if you like, or Catherine Mann crossing the floor. But let's not get carried away. Dr. Mann clearly votes and votes big when the direction of travel is, in her opinion, clear. That's all that we really learned. The gilts did not make the move I expected, just one more day, well, I'm glad I'm not a bond trader on the back of all of this, holding up steadily, although they have come right back into line with my suggested range of reason. So does this mean that rates will fall much faster than expected, after I've been rubbishing JP Morgan, Goldman Sachs and the likes for predicting 5 or 6 cuts this year. There will be plenty of getting carried away, I have no doubt. My 4.25% by the end of the year looks in trouble. Let's circle in on a couple of things. Firstly, I hate being wrong, but in this instance I'll gladly accept it as long as the rate is below what I've predicted. It would benefit me rather significantly, but as is often discussed, I don't talk my own book. I try to predict what I think will happen. Secondly, let's look at what the chief economist, who's fairly hawkish but never wanted to go to 5.5%, said. His voting record is pretty strong in terms of predictive powers. Everything he voted for, down to the 0.25%, was what we did on the way up to 5.25%. He didn't agree with the August 24 cuts he preferred to hold, but he did agree with the November cut, and he agreed with this one. A fair yardstick and a cautious voter, as one might expect given his position. And he spoke on Friday after Thursday's meeting. What were the highlights picked out in the media from this speech? UK can't say job done on fighting inflation. Stronger wage growth justifies caution on rates. Stubborn inflation may hold back rate cuts. We can't cut rates rapidly if inflation lurks. Bank of England chief economist says some colleagues rushing to cut rates. I think you get the picture. On the subject of if inflation lurks, it lurks. We can all see it, I'm sure, and we know we need to get through April with energy prices now pushing upwards and the employer's national insurance rise. This is a 3% inflation world, as I've said, and I see inflation above 3% this year, and no news at this time is changing that. Man's argument, it seems, is live with 3%, that's where it is, and get on with trying to help with growth, which is not a terrible argument at all. Does this mean she's guaranteed to vote downwards on March the 20th? Yes, I think so, pretty much, pending any major news. So is Dingra. Peel is surely guaranteed to vote hold after that chat. I suspect Lombardelli, the Deputy Governor for Monetary Policy, and Bailey will also vote hold. Alan Taylor, still on the fence, and we have very little voting record to go on. He could go either way. Ramsden is also prone to a cut and could go either way. And that leaves Green, Megan Green, who errs on the side of hawkishness, and Sarah Breeden, who has never voted out of line with the governor. We could see a 5-4 hold next time out, or a 6-3. I predicted a 7-2 this time around, but I thought the 2 would be holders, not cutters. Certainly not cutters of 50 basis points. And that's about as far out as I've been for 26 meetings as it goes. Hence the deep dive. Not a million miles off, and ultimately I got the result right, but it was the surprise from Man that really made me look into whether we might really see lower mortgage rates on the back of this meeting. So I'm sorry to disappoint. I'm sure plenty hoped that I would fold and confidently predict 4% or lower now by the end of the year. It's definitely more likely than it was in my book, but with the inflation situation pretty clearly out there, unless we really did go into a contraction cycle with the economy, and I don't think we will, I'm hoping for positivity in February's PMIs, from a low base of course, but we're not going to be cutting in short order. Hugh is the one who knows best, and in Hugh we trust. So as I draw to a close once more, I'll just take the opportunity once again to remind you of the sourcing course I'm going to be delivering on the 21st to the 23rd of March with Dan Kennedy and Nick Bond. It's all sausage and very little sizzle. Real-time examples of how we find deals on a daily and weekly basis, an experience of many tens of thousands of deals analysed to over 1,000 deals being done between us all. There's a reason why we call it Sourcing Solved, because that's what we're aiming to do. The information and tickets are at bit.ly/sourcing solved 2025. And remember to book those tickets for the 1st of April Property Business Workshop on due diligence. It will be the most comprehensive day on due diligence to have ever been delivered in the property space. I can guarantee it. So join everyone who's already booked their super early bird tickets at bit.ly/PBW6. So please always remember to keep calm, always listen to the supplement and carry on. Don't spend all your extra cash flow from that rate cut all at once, because there really isn't going to be a lot anyway. But keep smiling.